Welcome everyone to Tax Power Hour. Today is April 5th, 2017, and this is our April monthly webinar. Today's topic, it's employees versus independent contractors and self-employed tax issues. Today's content would be about 5 minutes to kind of introduce Tax Power Hour webinar, and we'll talk about maybe other events that we're involved with. Then we're going to spend about 15 minutes on talking about the cost. What does it cost to a small business to have an employee versus a contractor? And we're going to understand why they make certain choices, in some cases, the wrong choices of making employees independent contractors when they're really supposed to be employees. Then we're going to talk about IRS determination of worker status. This is where an employer mistakenly makes somebody a contractor, and then they use a special form to gather information and then make the decision to change that status to contractor. So between the first half an hour or so, the first half of the webinar, we're going to talk about a lot about this distinction between employee and contractor, just so we get that out of the way, we get that contextually understood in depth, and then we can talk about some of the tax deductions and the benefits of one or the other. Then we'll talk about the business expenses that self-employed individuals get, or independent contractors, people that have a Schedule C. We'll talk about the Schedule C. We'll talk about some of the challenge expenses that these group of people have. Then we'll talk about people that are not self-employed, that don't file a Schedule C, that they have unreimbursed business expenses. And that's a key important one, unreimbursed business expenses. We'll spend about 10 minutes on that. And then we'll the last 5 minutes, we'll kind of wrap things up. We'll talk about the importance of estimated taxes and the mechanics of it, and then we'll go to Q&A. All right. So about Tax Power Hour, we are a webinar series. There's a website, taxpowerhour.com. It's under construction. We're working on content. Probably during the summer of 2017, we'll add a whole bunch of tax content in there. But the most important thing is building a community around people helping each other with small business and self-employed tax tips. So I want you to join the Facebook group. Please join the Facebook group. Just search Tax Power Hour in Facebook, join the Facebook group, and this is where we can continue the conversation, start new ones, and even suggest topics for other monthly webinars. However, the monthly webinar, which is what you're attending live, some of you and some of you will be watching the recording, it's the main place where we communicate and interact. So this is every first Wednesday of every month. Each episode will be 30 to 60 minutes long. Today's will be an hour. I don't think it will be any less than an hour. In some cases, we'll have sponsored or collaborated content. In this case, it's not. This is all sponsored by me, and I'll introduce myself in a second. And this is not a CPE webinar, so this is not yet set up to provide continuing education for CPAs or enrolled agents. However, we're working on that. And very important, our discussions are about tax law, best practices, maybe tax software, maybe we'll venture into payroll tax issues, sales tax, taxation of legal entities, and other tax topics. We want to concentrate everything in the world of tax. About myself, my name is Hector Garcia. I'm a CPA based out of Florida. I have a CPA firm that provides technology services such as QuickBooks implementation and tax preparation and tax planning. My email is hector@garciacpa.com. If you have a tax or accounting question, I'm usually pretty good at answering that. Now, our guest is Mariette Martinez. She is based out of California, so maybe we'll ask her some California questions. She works with clients all over the country, mostly California and some in Mexico, I believe. She is a CTEC instructor. That means that she can teach other tax preparers in California, and she is an enrolled agent. Mariette, do you mind just kind of introducing yourself real quick?
Yes, hi everyone. Mariette Martinez, incredibly honored to be here. Hector is definitely an esteemed colleague of mine, so it's a huge honor to be here. I am an enrolled agent, which is really important to kind of identify what that means. It's not a CPA, which is something that we are commonly referred to as. A CPA is a certified public accountant, and that's what you are, Hector. Is that correct?
That's right.
Right. So a CPA is a designation you get through your state. You go through a very tough exam, and you get your CPA license. And enrolled agent is actually also a license, but we're licensed by the Internal Revenue Service, so the U.S. Treasury Department, and we're licensed just like CPAs to practice all over the U.S. and to do tax preparation. And so that's just a really important distinction, that enrolled agents are licensed by the U.S. Treasury, where CPAs are licensed by the state, but they are both licensed to prepare taxes. And just another thing that's really important to note is that, and I always tell everyone that is a client or even someone, a small business owner, is that it's always important to know that the person preparing your taxes has some type of license. So I appreciate Hector mentioning the CTEC. So there are states that actually require a license to even prepare a tax return, and unfortunately, there are still states that don't require a license. But highly recommend you go with someone that's licensed. And in California, you actually need to have either a CTEC from the California Tax Education Council. You have to have an enrolled agent, a CPA, or you also can be a tax attorney as well. So, or you can have the actual IRS's designation, which is an annual certification you can get from the IRS, but you do need to have some kind of designation to practice in California and to prepare in California. So just be mindful of that, everyone. Make sure the people helping you and giving you advice, most importantly, giving you advice, they know what they're talking about, and they do this every day, all day. They dream about it, like Hector and I do.
Thank you, Mariette. And I'll real quick go to your website. This is mariettemartinez.com. And I want to show you, I encourage you to go to her website. She's got a really neat resource here under Tax Center. And it says tax preparation templates. And she's got a few really nice spreadsheets that I guess she gives to her clients to prepare some of the work. So this is really, really good. So, you can actually steal from her if you're a tax preparer, or if you are, a small business looking for a tax preparer. This type of information that you can download from her website, spreadsheets or whatever, they could be really useful. So I wanted to make a quick infomercial for someone, for people going into your website and checking out the resources you have there. Okay, thank you, Mariette. And by the way, I did ask Mariette to explain what an enrolled agent is and the whole CTEC thing, because I'm not from California, and that happens to be different in California than the way it is in Florida. Quick disclaimer, and this is something that's required to do anytime you talk about tax in a public forum or something like that. First of all, I cannot give written advice. Mariette and I cannot give written advice or electronic advice or any sort of tax advice that is based on unreasonable assumptions. So it's very important to give extreme hypothetical scenarios. And these webinars are by concept extremely hypothetical. So these webinars are not tax advice. We have forever recorded this and is available to the world. And as practitioners, we're obviously saying things, and we're taking the risk of taking a tax position based on hypothetical situations. So our disclaimer here is this is not tax advice. This is tax conversation. Once you hear something from us, whether it's true or not, you still should consult your own tax professional, and you still should research the IRS and research the tax code. So that's really, really important. This is not tax advice. Now, if you Google Directory of Federal Tax Return Preparers with Credentials, the way it shows here on the screen, if you Google that, the IRS has a public list of CPAs and enrolled agents, what Mariette is. So I recommend that if you don't hire Mariette or me as your tax professional, and you have my email, so you can contact me, you have Mariette's email, you can contact her. If you don't hire us, get someone that is credentialed exactly as she says. Okay, so let's jump right into the topic, and let's talk about employee versus contractor. So the first thing to keep in mind is, and I want you to put the hat of a person that just got hired, quote unquote, and that's an important concept, right? Got hired, quote unquote, to do a job, and that job for that week or whatever, it's $1,000. If you're a person that just got hired to do a job, and let's assume that you're in a 15% federal tax bracket and you get FICA withholding, that $1,000 is really going to turn into a $773.50 paycheck. Okay, so we went from $1,000 all the way to $773. So the employee, most people are used to getting tax withholding, so that's not a big deal. But that's the number they have in their head. And that's also assuming that there's no state income tax and no additional deductions like health insurance and retirement plans and stuff like that, versus getting a straight check for $1,000. So think about putting yourself in the shoes of someone that is given the choice, where somebody says, do you want to be an employee or do you want to be a subcontractor? By the way, I'm asking the questions the way some people do, but this is not correct. This is not something you can ask and make a choice right on the spot. We're going to talk about the rules and what makes somebody an employee and a subcontractor. But imagine if you're a small business and you give the person the choice, and in front of them, they have the difference between a $700 check and a $1,000 check. What do you think they're going to, quote unquote, choose? So this is a big issue. The big issue is a lot of small businesses think that this is up to them to choose. And then when they're given the choice, obviously every single person is going to want the larger check. Now, how do you figure out tax withholding? So assuming that you're not in depth with payroll, if you're not really, really in depth working with payroll, the best thing for you to do is go to publication 15A. You can literally just Google that. And if you go to publication 15A, there are tax tables that tell you how much tax you should withhold. Now, there are general tax tables like the ones you're seeing here that are more for a sort of annualized type of income. So that lets you know which tax bracket the employee is going to be. However, based on paycheck to paycheck, it's much better to use the tax table. So I'm going to open that up real quick just to give you some context here. So here's my publication 15A, okay? And if I go all the way down, you're going to see something that is called the tax table. So basically, if you're a semi-monthly payroll and you have two allowances and you are married and you make whatever per paycheck $2,000, this will tell you exactly how much you need to withhold. So that's kind of the concept behind withholding. Now, most tax software takes care of that, and in a payroll processing software or payroll software like QuickBooks Payroll, whatever, they take care of that. So you don't have to make those manual calculations, but it's really important to know where that information comes from, because every new employee, if they're given, let's call it a choice, okay, between being a contractor and an employee. By the way, this is not a choice you make. This has to do with, where the employee qualifies based on a whole bunch of rules. But if they're given the choice and they want to know how much the withholding is going to be, well, you have to add FICA, which is 7.65%, which is the one that I put there, plus the federal withholding, which is going to be based on that tax bracket. So that's pretty much how you figure that out all in all. Now, let's talk about from the company's perspective. What if I am an employer and I'm trying to determine whether I want to pay an employee a paycheck or I want to have a subcontractor instead? Well, think about the math here. The employer has to match FICA, which is Social Security and Medicare. So the employer is going to have $76 of tax they have to pay off those $1,000. And then they also have federal unemployment tax, state unemployment tax, and I'm not even mentioning state income tax if there's any. And some states have, employer paid additional taxes that have to do with sort of the burden of being an employer. So if you look at just FICA, FUTA, and SUTA, that's going to be a net payroll cost of $1,109 versus a net check of $1,000. Again, if the employer is trying to make the choice on whether I should pay someone as an employee or an independent contractor, what do you think the employer is going to choose? Again, this is not their choice, but again, if they have a choice, what do you think they're going to choose? This is the point. The really huge epidemic problem that we have in the United States, or at least the stuff that I see with a lot of my clients, is they want to pay everyone as independent contractor. Why? Because you don't have to pay payroll taxes. You don't have to deal with the HR and all the other drama behind having employees, timesheets, you name it. And they just want to pay checks as contractors, and at the end give somebody a 1099 form. So let's break down the administrative burden just to give you some insight as of why an employer would misclassify an employee as a subcontractor or an independent contractor, sort of let's call it on purpose, right? So first of all, as an employee, you have to collect multiple documents: I-9, W-4, state employment reporting forms. Some employers do background checks, things like that. So that would add to the cost. You have to collect timesheets. You have to calculate and control overtime. You have to issue a net paycheck, which requires you to calculate the paycheck. You have to remit taxes, report quarterly forms to the IRS and state, and issue W-2s. And that's a pretty big burden. And we haven't even talked about, benefits and workers' comp and all that stuff. As a contractor, it's really, really easy. All you do is collect one form, the W-9. You get the invoice from the subcontractors. You pay them their check. You don't have to deal with overtime. You don't have to deal with timesheets. You issue a regular check and you report one form at the end of the year. So that makes it so anyone that's given the choice is probably going to choose subcontractor, but in some cases not correctly. Maria, do you want to add anything to this before we talk about the eligibility rules as for subcontractors?
Yeah, just something quickly. I think just to keep it really simple, I mean, for the accountants that are on here, tax preparers, and even small business owners, or those that are contractors themselves, I think ultimately it's just really important and an obligation truly to make sure that if you are categorizing from a small business perspective, if you're categorizing someone as a contractor versus employee, they've only been an employee their entire life, and then you turn them into a contractor, or they've been an employee, they started with you in a new job, and they become your contractor. Please be mindful that they may not understand anything we just said. They may not have any idea what it means to be a contractor, that they're going to get a 1099, that $1,000 check that Hector just showed you visually, used to be, $700 because withholdings were taken out. Now it's $1,000. What does that actually mean? That means they need to withhold, the Social Security, the 15.3%. They need to withhold income taxes for both federal and state, because unless you're in 3 or 4 states, 5 states, you definitely have to pay state taxes. So just be mindful of that. That's really important. I really feel it's our obligation as a citizen to let people know what they're getting themselves into. So that's really the most important thing that I want to note and interject here, is that be honest, be transparent, and make sure everybody that is on that boat, especially being a contractor, understands what that really means.
Yeah, that's a great point. We haven't gotten there yet, Maria, and we're going to discuss that. That $1,000 flat check that the contractor gets is not really $1,000, because there is going to be more self-employment taxes that they're going to have to pay, and we're going to discuss that a little bit later on as we talk about the burden of the self-employed individual. But we're talking about just the check itself, which is the sort of the first interaction that the contractor or employee gets with the business. Let me run a polling question real quick, because I want to know how familiar are you with the differences of employee and independent contractor, because we're about to get pretty in depth with the differences, and I'd like to kind of know where we are to see how much time we spend in explaining them, or if we can go through it rather quickly. So we have about 65% of the votes. We'd love to get a little bit more, maybe 80, 85%, just to get a good sample of the group here. So please answer the polling question. It'll give me an idea of what that is. Okay, so we got about 80% of the votes. Let me close the polling and share the results. So from the people on the webinar, about 65% are very, very familiar. So I'm not going to spend a whole bunch of time explaining it, but I am going to go to the most important things. And then 25% somewhat understand it, but don't work with it often. And then a few just don't know that much of it. Okay, great. So let's go into how the IRS determines whether a contractor has been misclassified as an employee. So rule of thumb, if you're a business and you're paying someone for services, rule of thumb, you should default to employee. Okay, that's always the conservative approach. Again, that's the most expensive and the most burdensome, both administratively and with tax costs for the small business. But your conservative approach is to treat every single individual that works for you as an employee. However, we explain what the great benefits are of having an independent contractor instead of an employee, so we know why people would be encouraged to classify someone as a subcontractor. So let's talk about how the IRS determines this. And basically, this is a three-prong approach. It's behavioral control, financial control, and type of relationship. So think about those three. Generally speaking, behavioral control. Do you control what time the worker comes in, how they do their work, right? How they do their work, whether or not you train them specifically on how they have to do the work. Okay, do you control their schedule? Okay, do you give them tools? Do they use their own tools? So think about that. The more behavioral control you have, you give them tools, you control their work, they work at your office, that sort of thing. That's going to be more towards employee. If you don't control what time they work, how to do the work, and they use their own tools, then that you have less behavioral control. Therefore, that moves more towards independent contractor. Okay, let's talk about financial control now. Are they exclusive? So does that employee or contractor make all their money 100% from your business, or do they have other businesses that pay them? That's a really important one, because if they basically live off your business and it's been a year, 2 or 3 years, and their only source of income is your business, that looks like you have a lot of financial control over them. So that's a really important one. How they get paid. Like if you specifically say, no, we're going to give you a direct deposit and it's going to be this day, it's going to be that day. So if you determine how they get paid rather than them giving you an invoice and giving you terms, or determine how the expenses are reimbursed, or who pays for materials, who pays for supplies, all that stuff matters. So think about it. If you pay for all materials, tools, and choose how they get paid and they get reimbursed, you got financial control. If they use their own materials, their own tools, they invoice you, right? And then they give you terms of payment, and there's a contract, and they have risk that you may not pay if they don't do the work correctly, then you have less financial control, and that moves more towards independent contractor. Okay. Now, the last one is type of relationship. So do you have a written contract? Really important, right? An independent contractor, it's a contractor, which means they work based on a contract. Really important. Is the contract permanent? Is it short term? So if you got short term contracts or one time job type of contracts, that helps a lot. If you actually give benefits, give vacation pay, give bonuses on performance, all that stuff makes it much closer to be it being an employee. Okay, so that's really important. It's the type of relationship, right? Okay, so those are the three sort of high level things you want to think about: behavioral, financial, and type of relationship. Now, there is a form called the SS8 form. This is an official form that any IRS agent will use to determine in an audit or maybe a proceeding in which they're trying to figure out if you have misclassified contractors. And this is the type of information they gather. So I'm going to pull up the SS8 form just so we can get an idea of what that looks like and to see exactly what is it that you will be dealing with. So there's about 57 questions. Things like, how do you obtain the job? Do you fill out an application? Did you bid an estimate? Right? And there are some things that are not simple answers. They're like, describe the business, the type of questions that the IRS will ask. Things like, where is the job actually performed? Some of these are just to describe it. Describe whether or not there's specific training, right? Is there a specific training? How do they get work assignments? Do they get work orders? Do they get, purchase orders? Things that look like a third party relationship. What type of reports are they required? Do they give them performance reports? They give them daily reports? Do they just get invoices? All these questions, it's amazing. If you go to this form, it is amazing the amount of information that they gather. And by the way, this form at the end, unlike almost all the IRS forms, this one does not tell you at the end, this means based on your answers, they're a contractor or they're an employee. There will actually be a subjective approach, like an actual agent will read this whole thing, and based on their subjective mind, using tax rules and stuff like that, they will determine whether the answers from this form moves it more towards employee or subcontractor. So I think it's extremely valuable for you to get familiar with that SS8 form. Now, there's another document that's actually a little bit older, but a lot of people like it. Where is my document here? Which is called, and you can download it from the handouts. Oops, not this one. Where is it? Sorry about that. Okay, let me Yeah, it's on the handouts. Let me go ahead and copy and paste this up here. Now, this one is called the 20 factor test. This is an old document that it was published by Senate and the IRS, and there was a whole bunch of people involved with this document. And this document is actually pretty neat. It's over 10 years old, but it goes through 20 factors that makes it much easier to understand. So this is actually an easier approach to the SS8 form. But it talks about instructions, training, integration, hiring, supervision, relationship, doing work in the premises, how they get paid. If you actually go through this 20 point system and read this 17-page document, I know it's not fun, but between that and the SS8 form, you should have enough tools to determine whether someone should be an employee or a subcontractor. Now, if you are a business that now after this webinar is realizing that maybe you misclassified your employees as subcontractors, or maybe you're an accounting professional and you're starting to detect that maybe they misclassified them, there's a form called the 8952, which is called the Voluntary Classification Settlement Program. So if you're worried that your misclassification is going to turn into an audit and just cause a huge mess in terms of penalties, back taxes, you can actually voluntarily reclassify your employees, and the amount of penalty is much lower. Mariette, do you want to add anything before I go to the next slide?
Yeah, something I definitely want to add. My gosh, Hector, seriously, that was a lot of stuff. You really did a deep dive into that, more than I've ever have. But I just wanted to go ahead and mention that you definitely want to look into your own state. So these were awesome, kind of federal forms, but all states have actual Department of Labor forms. In California, we have the Employment Development Department. We also have the Department of Labor. And so please go onto those websites, do just a super Google search. I mean, I just did it while he was talking. In less than a second, I found the Employment Development Department's, workers classification form. Ours is called the DE38. And then of course you go to the Department of Labor and they have their own form as well. So please also remember, we're kind of always going to talk more high level federal, but please consider your state regulations and your state requirements as well.
Yeah, it's really important. The states have their own regulations, but I'm discussing it more in the context of 1099 versus W-2 employee, that sort of thing. Okay, so let's kind of wrap this up. So if you're a small business and you have an employee, let's talk about some of the sort of pros and cons. So this is kind of the summary of that conversation before we move into the tax deductions. The companies will have the burden of paying payroll taxes. So we talked about that. And you also got unemployment taxes, and some states have special taxes. I know California has a training tax. Florida doesn't have that. Different states can have different taxes related to having employees, and most of those taxes go to fund unemployment programs, people that get hurt in the jobs. I don't know how OSHA gets funded, but people that get hurt in a job and the companies can't pay, or people that get fired, wrongfully fired, and then the state has to pay them while they sue the company and that sort of thing. So different states have different ways that they fund those programs that protect employees. Now, in addition to paying, their payroll, you may have to pay workers' compensation. Some industries in some states have to have workers' compensation. In Florida, for example, every company, every industry has to have workers' compensation once you have 4 employees or more. So a lot of companies try to stay within the 3-employee mark to avoid that. But in some cases, it's just not worth it. You got to get that extra employee. You got to pay workers' comp. So every time you add another employee, they'll be added to the workers' comp. Then you got employee benefits. In order for you to have an employee benefit like health insurance or 401k, they have to be non-discriminative. So once you give access to that benefit to one employee, like let's say the owners want to get a pension plan and they want a 401k and they want a health insurance, the owners can't discriminate with the other employees, and they have to make it available to every employee. So that will add on to that cost every time you add a new employee. So that's a really important point. In some cases, if you have employees, not contractors, employees that live in other states, you may have nexus, and that's a huge issue because if you got a company in California, for example, and they have a contractor, let's say in Ohio, I'm just going to name it out there. I don't know the rules in Ohio or California. You may not have to file state tax or income taxes in Ohio just by having a short-term contractor. But I'm sure that the California laws force you, let's say California and New York. Let's say you have an employee in California and also employees in New York. I am sure that New York somewhere says, hey, if you got an employee here, you got Nexus here, which also means you may have to file a state tax return, a state income tax return, and you may also have to deal with sales tax. So in those cases with multi-state, small businesses want to stay away from having employees in other states. And in most cases, if you got people in other states and you go back to the rules and figure out the behavioral control and all that stuff, financial, behavioral, relationship control, it is possible that you can have a subcontractor, especially if they're in another state where they don't step foot in your office and that sort of thing. So that's a really important thing to keep in mind. A lot of people don't think about that. Between workers' comp, taxes, all these additional burdens, I've seen anywhere between 8% to 25% as the actual additional out-of-pocket cost to the employers of having employees. Again, I'm not saying that you should have subcontractors in order to avoid all these expenses. I'm just saying this is a reality. These burdens exist, and this is why some people could be encouraged to potentially misclassify their employees as subcontractors. Now, there's also what I call the drama of having employees, dealing with all the human resource part, right? Sexual harassment, people mistreating each other, wrongful termination. In a lot of cases, you need to have an actual manager to manage the staff, manage the time that they come in, manage their work. If you had employees, it's a bunch of drama behind it. So a lot of people just want to avoid that and having independent contractors instead. Okay, let's talk about now the pros and cons and kind of the summary of an independent contractor. So usually independent contractors will not receive any employee benefits. So for the most part, there won't be an additional, let's call it payroll cost or benefit cost to the company. Administratively speaking, it's very easily, all you have to do is get an invoice, pay the amount, file a 1099 at the end of the year. Very important, since contractors are short-term in nature, because it's a contract, firing them or getting rid of them or replacing them is typically pretty easy because the contract ends. When terminating employees in certain states may have specific rules and regulations, okay? And the other challenge you're gonna have is independent contractors, typically because they don't have to abide by a schedule, they have to use their own tools. They cannot get specific training on how to do the work. In some cases, you will find that independent contractors cannot give the same quality of work that an employee can, just because it's much harder to quote unquote manage them. And if anyone's ever dealt with contractors of any sort, the stigma behind contractors, you know exactly what I mean by that. So those are kind of like the pros and cons of that. So good. So now we're halfway through the webinar. Let me run one more polling question, and just to kind of give me a break. And Maria, do you want to add anything to that?
No, you definitely gave a lot of reasons why, and like you mentioned, we're not discouraging you by any means to classify someone one way or the other, but we have to be honest and say there are people that believe, it's just going to be a smaller cost, or it's even mentally, like you mentioned, running a firm with staff, dealing with personalities. Yes, it takes more time, but the fact that you can come back and get audited and have to pay all of those back payroll taxes by misclassifying is a much bigger issue. I've seen businesses go out of business because of misclassification audits. So just be mindful of all the rules, why not. And I have actually even have solopreneurs that have decided to have a lifestyle business where they just don't want to ever have employees. They basically just want to have they want to scale down, have a smaller business because they can definitely hire a contractor here and there and classify that person the right way and not have to deal with the employee side of it because they are well aware of the importance of these rules.
Okay, perfect. Let's see. Okay, good. Thank you, Mariette. Let me go ahead and close the polling question. And I kind of just want to know whether you yourself are an employee, or if you're a self-employed individual, or if you file C Corp, S Corp, or multi-member LLC. And by the way, if for whatever reason you have multiple, just kind of state the one that gives you the most, what your largest source of income comes from, because that would be the most significant one. So that'll get us an idea for the folks that are in the webinar where we are. So let me close the poll and share the results. And as you can see, 45% of you are self-employed. So the largest majority of the group here are self-employed. So obviously very interested on the topic. And then we have some people that are employed, and then we have some that are that have corporations. Okay, perfect. So I'll go ahead and hide the results. Okay, so now let's talk about now about the tax return that self-employed folks have to fill out. This is called the Schedule C form. Okay, most people in this webinar are probably very familiar with it, but I want to discuss a couple of items from it. The most important thing and the most important question that I get is tax deductions. Okay, so people tell me this is the question I get every single day of my life, right? No exceptions. What can I deduct from my business? And there isn't enough hours of the day to sit there and recite every single possible thing that you can deduct from the business. The IRS doesn't do that. Our government, in the tax code, nowhere in the tax code, it gives you a list of things that you can deduct. There's no such thing. Okay. However, there's a general rule. The rule says necessary, ordinary, and reasonable. So you need to build into your head the concept of ordinary, necessary, and reasonable. Necessary means you must pay for that in order to conduct business. Again, you must pay for that in order to conduct business. If you must make a payment to buy something or pay for something in order for your business to survive and thrive, then that expenditure becomes a deduction. Ordinary means that it's normal, that is tied to the industry, that the IRS auditors are used to seeing it. If you Google that, it is normal for a person engaged in that type of activity to spend money or pay for that type of service, whatever it is that you're buying for. And then reasonable means, and that's a very subjective word, it just means not lavish. Like, do you need a car to drive to your clients to perform the work? Yes. Do you need a Ferrari? Probably not. Okay. Do you need to take your client out to lunch in order for you to maybe close a deal? Yeah. Cheesecake Factory. Yeah, sure. $100, $200. Do you need to take him to the single most expensive restaurant in Miami Beach that will cost you $3,000? And then at the end, your business that you perform is $100 worth, then that's completely unreasonable. So that's kind of like what it means. And obviously, I'm stating opposite poles here, extreme circumstances. But just kind of put that into your head: necessary, ordinary, and reasonable. And then you don't have to ask anyone, any CPA, can I deduct this? If it's ordinary, necessary, and reasonable, as long as it's legal, by the way, they didn't put legal as not here, but it must be legal. Like, you can't bribe someone, you can't bribe a government official and take a tax deduction, right? That sort of thing. Okay. And lobbying, that's a whole nother ballgame. I don't deal with large companies that lobby, but lobbying generally wouldn't be, because that's almost kind of, I don't want to call it a bribe, but it falls into that gray area. So we're talking about more of the operating expenses. Okay. Now, if we look at the Schedule C form and we go through all those lines, let me pull up the Schedule C form real quick so we can talk about what the IRS gave us. And by the way, we are not limited to these categories. Okay. They give us cost of goods sold, advertising, car and truck expenses, commission and fees, contract labor, all the way down to utilities, wages, and other expenses. So the stuff that's not listed here, you're going to summarize it under other expenses, and you're going to put them in a box all the way in the bottom here, where you're going to list them. And the form only gives you a few lines, so you can always add additional schedules for that. Now, why does the IRS only give you these categories? Well, that's what they determine what they want to track. Now, we're going to talk about statistics for a second. These categories are very important for statistics, and we'll discuss statistics in a second. The Schedule C form is the form that gives you the most categories out of any business expenditure forms. Not even the S Corp, C Corp, partnership. Those forms don't have enough boxes to provide nice statistics. So the Schedule C provides the best statistics, and we'll discuss that in a second, that the IRS makes public to let you know more or less what most people put in those boxes. So now, again, this is not tax advice for you to use that as any guidance, but I will show you how to get that information, which is extremely valuable. Anyway, let's discuss the tricky ones. Okay, car and truck expenses, travel, and home use, any home use of the vehicle. Okay, so car and truck expenses. So we'll discuss that a little bit later. We did have a whole webinar. You can search it in YouTube episode that talks about these tricky ones. This is what we call the often misunderstood expenses. But long story short, in order for travel to be deductible, it must be necessary, ordinary, and reasonable. Obviously, you have to conduct business. If you combine pleasure and work in travel, you must make a calculation. You must split it. Meals and entertainment, that's not for you to feed yourself. That's for you to entertain. Take out a client, take out a contractor, take out a partner, not a business partner, but I mean like a strategic partner to discuss business while you're eating. And even that will make it 50% deductible. Now, car and truck, the tricky part is some people want to use actual expenses. That means they'll actually calculate depreciation, actually calculate gas, actually keep track of the repairs and maintenance, tolls, parking, all that stuff, and then multiply that times the percentage of business use. And that percentage of business use is done by mileage. So if you're going to calculate mileage anyway, you might as well figure out how much miles you use for business, multiply it times the annual rate, the rate of that year, which 2016 was 54 cents. I forget what 2017 is. And then calculate the mileage times the cents, and you have to make a choice. You either take the mileage as a deduction, business miles, or you take the actual business expenditures, multiply times the business use. Now, another tricky one is depreciation of personal assets. So if you buy a laptop that's used both personal and business, then you have to figure out what that percentage is, and laptops don't have mileage, so that's going to be more of a judgment call. And then you're only going to depreciate the portion that you use for the business. So typically, I advise my clients, make sure you have a computer at home, the rinky-dinky one for personal use, and have one exclusive for business use so you can depreciate that whole computer. Home office expense, also very tricky. In some cases, people want to calculate utilities, depreciation of the home, any expenses directly related to maintaining the house, and then multiplying that times the square footage of dedicated space divided by the total square footage of the house. Or you can use the simple one, which is just take the square footage and multiply it times $5, and that would be your annual deduction for that. Now, so these are the tricky expenses, and again, the Schedule C has a whole bunch of other categories. I want to talk about something called self-employment tax. And self-employment tax, it's one of the biggest problems with being self-employed. We talked about earlier that most companies are going to want to pay as independent contractors. And a lot of people want to be a subcontractor or an independent contractor and get that 1099 because they don't get money taken out of their paycheck. However, the problem is a lot of people don't realize that there is a cost to doing that. There's something called self-employment tax, which is basically 15.3%, 12.4% for Social Security and 2.9% for Medicare. This tax is paid for by employers when they pay their employee half of it. So the employee only carries the burden of half of the employment tax. When you file a Schedule C and you're a self-employed individual, when you get a 1099, you have to pay both the employer and the employee side, and that totals to 15.3%. So on top of your regular income taxes that we talked about, the tax brackets, you have to pay this self-employment tax on the net income of your Schedule C. So if you get a 1099 with, let's say, $10,000, $100,000, you must look for all these business expenses to reduce that, and whatever the net income result from that Schedule C will pay your income tax at your income tax bracket plus the self-employment tax, and you really can't skip or avoid that self-employment tax. And this is what Mariette said earlier. People get surprised at the end of the year when they're paying taxes. They're like, why did my tax fly so high? And most of it, I'm telling you, especially for low income earners, people making under $60,000, $70,000 a year, this is a huge burden because this is not a progressive tax. This is a straight 15.3% of the net income. Maria, do you want to add something? Did I miss anything on the on self-employment tax?
No, you definitely explained it right. I mean, I think what happens is in the misconception is, everyone focuses on the 15, percent, and they forget. And the good thing about the 15%, and Hector made it very clear, it's net profit. So then, okay, I'm going to get enough deductions and that's fine. But still, there's several taxes, again, going back to that initial example. You got self-employment tax, you got federal income tax, you have, your state income tax, and depending on how high your profit could be, you could have other, option or unfortunate opportunities to pay other taxes. Let's say even alternative minimum tax. So just again, it goes back to just being well aware of what all this means. And I kind of just want to interject quickly on when he talked about expenses. Incredibly important to understand. Yes, they have to be reasonable and necessary, but remember, every industry is different. So where someone that's in maybe the entertainment industry is deducting makeup and hair and specific purchases, costumes, let's say, or costume designers, that makes sense for them. Well, getting our hair and makeup and our nails done doesn't make sense for the accounting industry. So that's also very important. It has to be reasonable, necessary for your line of work, for your industry. So because a lot of people, I talked to my friend and they said this and that. Well, your friend, what do they do? Always go back to that. And I just want to make sure you know that, because self-employed, we could be over 60 million of self-employed very soon. So we're talking about a very big pot here.
Sure.
So I just want to make sure that's clear.
Sure, and keep in mind something else. Every time I get a new client that is a self-employed individual, and I'm doing the tax returns for the first time, and I'm looking at past years, 2 years ago, 3 years ago, and I'm seeing, maybe they prepare their own taxes, or maybe the tax preparer wasn't a CPA or an enrolled agent, or maybe they were, and you notice that they were very aggressive, like they had these really big numbers in that Schedule C forms. Go back to this, these expenses, the cost of goods sold, the advertising, they have some really big numbers, really aggressive positions. And when you actually do the accounting for this year, we realize that a lot of the things in there were quasi-personal. And I'm more of a conservative accountant, by the way. You don't want to hire me. I'll make this a public announcement. You don't want to hire me if you think I'm going to be extremely aggressive and take frivolous positions on things that are personal expenses. I'm the type of accountant that will prepare your tax return and will literally want you to walk out of an audit with the auditor an hour later saying, you know what, we have nothing else to look at, goodbye. That's my style, right? So different accountants have different styles. However, anytime that you go to an accountant and you think you're paying a lot more taxes than you were with a different one, where it's because the difference between the two accountants is how aggressive they were taking the position on expenses, especially the tricky ones, car and truck, personal use of the home, meals, entertainment, and travel. Because a lot of these things are straightforward. Like, you pay bank fees at the bank. It's a dedicated bank account. Okay, you have a subscription to your industry magazine, which you put at your office. You pay your rent. These things are straightforward. These are not gray area. But you bought 6 computers and your kids use half of them, and you want to throw them all under the business. That's the stuff that's gray area, and that's the stuff that requires you to have extra documentation and an accountant that really understands the position. And most accountants do take a conservative approach. So I apologize to all my clients and anyone that I never told them that, but I don't take aggressive approach on things. If we got documentation and it makes sense and it's reasonable, then we do take the deduction on it. But this is where a lot of self-employed individuals can have a wider range of results in their tax returns. It's on how aggressive they go after those expenses. Anyway, let's move on to now employed individuals, not self-employed individuals, but employed individuals, people that get a W-2. And the problem is that people that get W-2 and then they ask me all the time, hey, what can I deduct? The problem is that although you can deduct something that's called unreimbursed employee expenses, which is basically anything that you had to incur, again, ordinary, necessary, and reasonable, in order to perform your job, it's deductible. However, it is subject to what's called a 2% AGI floor. In other words, If I make $100,000 of net income, that's my AGI, $100,000, okay? 2% of that is the amount that I cannot deduct, even if I actually had business expenses. Okay, does that make sense? Mariette, did I explain it correctly? So the first $2,000 of your $100,000 cannot be deducted, and you can only deduct the amount over that 2%. So if you make $100,000 and you have, let's say, $3,000 worth of business miles, okay, calculating it with the 54-cent rate, you can only deduct that 1,000 dollars. And then on top of that, because there's another complication that has to do with the mechanic of the Schedule A, on top of that, the Schedule A itself, if it doesn't reach $6,000 for individuals or $12,000 for married folks, it doesn't provide an additional benefit because you get the standard deduction anyway. So this is the really tricky part, that people come to us and say, can I deduct this? Can I deduct that? And if we give them a straight answer, yes, we can, because technically you can, at the end, it doesn't make any difference in the tax return, and then somehow we give somebody bad tax advice. So people come to me all the time. Can I use my home office and deduct it? I say yes. Can I use my business miles that weren't reimbursed? Yes. Can I use my office supplies that were not reimbursed? Yes. Can I have incidental or meal expenses while traveling that were not reimbursed? Yes. All those things are deductible. The problem is many a times it doesn't even reach the AGI, and many other times you don't have enough things on your Schedule A in order for it to even cost any benefits. Mariette, since you are also a practitioner and you probably deal with this stuff all the time, did I mention pretty much everything that goes on with the challenges around unreimbursed expenses? I know you work with a lot of Form 2106s.
I do. Yeah. I think with the 2106s, the big thing is, I always tell my clients, because they get excited about the Schedule A, and many of you hopefully know, as tax practitioners or even W-2 employees, the first thing that usually gets you on a Schedule A is your home. So you buy your first home, you're super excited, you have mortgage interest, you have real estate taxes, you'd have now charitable donations, and all of that, like Hector just said, gets you over that, let's say $12,000 to $13,000 mark if you're married. And then you said, oh, but I heard that I could also do my unreimbursed employee expenses. So if you're making, let's go back to the $100,000 rule. So I mean the 2% rule with $100,000 in AGI. So you can't even deduct $1 above until you reach 2,000 in expenses, and then every dollar after that. So what I always tell my clients is I look at the Schedule A and I tell them, okay, awesome. You got your mortgage interest, you got your taxes, you got your donations, everything that's dollar for dollar. How does it look now? Like, do you like your refund? Is that all good? Do you want to go and dig up, all of those unreimbursed expenses? Because this is the difference it's going to make. If they are high net worth individuals, I'll tell you right now, they usually don't qualify. Because we're talking about $200,000-$300,000. So that 2% is really high. If they said, well, Mariette, I'm in sales and I really take these clients out and I buy them gifts and I have to take them out and wine them and dine them and all that, and I don't get reimbursed, and I drive a lot, not commuting, remember, not commuting, business miles. So driving the clients here and there, going from appointment to appointment within your employee requirements of driving for that company. When they pile all that up, and if we're talking about, $10,000, $15,000, then maybe it makes an impact. But just be mindful that, again, you hear, oh yeah, I heard I can deduct this. Yeah, but there's specific rules to specific line items on specific forms. And the Schedule A, believe it or not, is one of the trickier forms because there's different rules on the different lines. So just be mindful of that. But the one that everybody always talks about, like Hector said, is the 2106, because you're an employee and your coworker talked to you about it. So you're super excited to get that deduction, but you have to be mindful of what that really means.
Right. Unfortunately, the tax code is not simple like math,
Yeah.
where it's the word deductible doesn't mean you take it off the top and that's it. It just means that maybe through the mechanics and calculations and filters, possibly you can deduct it. I mean, that's really the answer that we have to give most of the time. So that's kind of the challenge that us practitioners have when people ask us those blanket questions. Can I deduct this? Can I deduct that? So I wanted to show you real quick the Form 2106. Notice it's got 5 lines in there. You got vehicle expenses, and that tells you to go through the instructions to talk about mileage. It goes to parking fees, tolls, transportation, travel expenses, business expenses. This is stuff like this would be all the generic stuff like office supplies and stuff like that. Like, for example, I have a client who's an elementary school teacher, and she spends about about $9,000 to $1,000 a year worth of teaching supplies. She doesn't get reimbursed for them. She asked me at the beginning of the year, hey, is this deductible? Right now, I had like 2 minutes to answer, so I said yes. However, and then I explained it, and then basically she blanked out everything else that I said after I said yes, and then she went haywire buying all these, office supplies, thinking, oh, this is going to be a deduction anyway, so I don't care about spending it. And then when we actually go through the 2% rule, she didn't even spend enough in supplies for this 2% rule to actually matter. I mean, yeah, there was a small deduction on the first page of the tax return that was limited to $250, but the problem was that she spent $1,000, and in her mind, the whole $1,000 was going to be deductible. So it's really, really tricky to answer blanket questions like, "Hey, is it deductible? Is this not deductible?" Okay, let's go to, and we're running out of time here, so I want to show you the stuff that I'm mostly excited about, which is there are trends in the self-employment world because there are so many people, Uber drivers, Lyft drivers, people that rent their houses in Airbnb, people doing work online in Care.com, Upwork, people having Square, point of sale systems on their phones. So basically, there's a whole bunch of new trends of a lot of people receiving quote unquote self-employment income because it's happening through all these channels here. So there's a website on the IRS called the Sharing Economy Tax Center, which has tons of resources around that. So I recommend that heavily. Now, the last thing I want to show you, which is my favorite thing, probably going to be my favorite thing or your favorite thing on the entire webinar. So if you stayed this long, this will be an absolute treat. Okay. The IRS every year uh, uh, publishes statistics, and they're usually about 3 years behind. Okay, so the last statistics that were published was 2014, and if you actually the link is in the PowerPoint presentation, and I'll put it down in the description. I'm going to copy and paste it down in the description so you can see it. You can also download it from the handouts. But if you go to that particular bulletin, you're going to see a lot of interesting, cool things. I want to show you with the short time that we have. I want to show you the stuff that's in there. It's very, very interesting. So, for example, 24 million individual tax returns had a Schedule C form. 24 million. If you're a tax preparer, the opportunity is huge. It's bigger than corporations to specialize in this. And if you actually go a little bit farther down, it tells you how many were filed per industry. So you see right here, 3,000 under professional, scientific, and technical services, 2,000 under construction, 1,000 under transportation and warehousing. And by the way, that's a million. So I meant to say 2 million, 3 million. So that lets you know more or less based on the industry how many are being filed, and that's useful. However, another piece of information that's useful as you go deeper down, you get to see the average revenue per year. So you get to see trends on how much self-employment income has gone up over the years. You get to see stuff like the average deduction. So if you see this one in particular, I love this one, you see that 14% of the entire, so out of all the Schedule C forms, the average is 14% of the revenue that gets deducted as car and truck expenses. I am not saying that you should use it as a guideline, whereas if you look at a Schedule C and car and truck expenses are close to 14%, and you're like, oh, this is going to be about average. But it's important for you to know that the IRS uses mathematical systems to audit returns, and statistics play a huge part of it. So if expenditures are very close to average, and by the way, this is not tax advice, I am not making any advice that says if you stay within these percentages, you're less likely to be audited. I'm actually prohibited to say that. But I am saying, as a lover of math, that if the IRS uses statistical software to figure out which tax returns could be out of place, they're probably going to go with things that are beyond the averages. So if you have, for example, a business in which office expenses or commissions are 20, 30, 40% of the revenues, and the averages are 2 and 1%, it is possible. Again, I'm not saying it didn't work for the IRS or anything like that. It is possible that it would be way out of out of the bell curve. So statistically speaking, it could be an outlier, and maybe the computer will flag it for an audit with a higher probability of one that falls more within the averages. Again, I'm not making advice in terms of that, but and this is a great, awesome report. It actually goes in by industry. It tells you by industry, number of returns, total receipts, total rents. So you can actually download, if you actually go to the link here, which is the statistics page. So I'm gonna go into the statistics page link, and I also paste that on the chat box below here. The statistics page, you can actually download a spreadsheet, which is actually even more amazing. Okay, if you're a numbers guy like me, and you can download the spreadsheet itself, and you can calculate percentages. You can do all sorts of statistical analysis, industry by industry, expense category by expense category. So if you really want to know what America's Schedule C looks like, broken down by industry, for 2014, that data is there. And trust me, that data doesn't really change so much year over year. So I'm going to wrap it up on the last thing. Maria, do you want to add anything to that? Have you ever looked at those statistics before?
I have looked at statistics, but not those. And I am embarrassed to say that I just found out about that Sharing Economy Tax Center. So thank you so much for sharing that. I've already pinned it, I've already bookmarked it, and I'll be adding that to my website. So thank you for sharing that. I mean, your resources are unbelievable. Thank you so much for this webinar.
Perfect. So yeah, so check out the statistics page. They're pretty neat. You also want to take a look at the number of tax returns. There are LLCs filing as Schedule C. It is incredible. It is astonishing how many LLCs are filing as self-employed. So a lot of people that are corporations or they're limited liability companies, you would think that, oh, they're a company, but they're not. For tax purposes, they're just a self-employed individual because they file Schedule C. In 2014, it was 1.6 million. 2013, 1.4 million. So that 2017 must be already at 2 million. That means that, right now there's 2 million people with LLCs that file as Schedule C. So the self-employed market, it's much bigger than most people think, because that's the huge trend. People set up LLCs and they're single members and they have to do Schedule C anyway, or a lot of companies downsizing or subcontracted their employees. So you see a huge boost of self-employed individuals in the past 10 years, and I think it's gonna even grow even higher in the next couple of years. The last really important thing I wanted to talk about is estimated taxes. Most self-employed individuals fail to make estimated taxes, or they don't know. You are required, if you don't have a W-2 and you don't have withholding, you are required to pay quarterly estimated taxes that equal at least 90% of your tax liability, split into 4 payments: April 15, June 15, September 15, and January 15. Typically, because most people don't know what their tax liability is going to be, the IRS allows you to pay 100% of the previous year. So even if you actually owe more, you don't get an underpayment, estimating of tax penalty. So that's a really, really important piece. Now, how should you calculate or have a plan for your estimated taxes? I strongly recommend that you work with a CPA or an enrolled agent. That gets really tricky, as you see with this webinar. Tons of moving parts. If you're a do-it-yourselfer, one that doesn't hire a CPA or enrolled agent, you can try QuickBooks Online with an app called Tax Planner Pro. Very neat, very cool to estimate your taxes. Or you can use a new software called QuickBooks Online Self-Employed that connects to TurboTax and also allows you to make those estimated taxes. Let me do the last polling question before we wrap things up. And I appreciate the people that stayed a little bit over the hour for this. Okay, so there's a last polling question, and this really lets me know whether or not this is something that I was on the right track of teaching something new, or was I repetitive? Did I, the people that joined live, which is about 80 people, was this the right target? Should I do more webinars like this? This question really allows me to know where I stand there. Mariette, what else do you want to add on the world of planning and keeping track of your expenses and planning for estimated taxes?
Yeah, I think the one thing I want to add, just because I get this all the time from, new clients, and that is really my passion, is the new 1099 contractor that just figured it out. Hopefully they're, the person they're working with, remember, it's not their employer. It would basically be their client. Let them know that they are a vendor of theirs and they're a contractor. And so hopefully I get in contact with them during the year and I get to sit with them and explain to them what that means, and I always put them in an electronic solution. So, well, why? Why do I do that? Because, doing the whole exporting your activity into Excel and then resorting and putting it in tabs and all of that, it's just so much work now, guys. When you can use something like QuickBooks Self-Employed that Hector had mentioned, which is only $4 a month, and it's deductible. It's a business expense, or QBO that you can get in there for maybe $30 a month. Or if you work with an accountant like Hector, they can do something called wholesale billing where maybe they can give you a better price. But the point is please go into an electronic solution. And we're not pushing QBO or QBSC. There's others out there. There's one called Wave. There's Zero. There's others out there. But the point is, please go electronic, guys, because at the end of the year, you're going to see that it's incredibly valuable. And not only that, a lot of these apps have amazing additional features. Like the self-employed app actually has an integrated mileage app, or QuickBooks Online, you can integrate other solutions. So, when you hear that your accounting professional, recommends apps and you're like, oh God, there they go again. It's all about technology. It's to the benefit of you. And don't forget, that is an ordinary and necessary deduction. So you are allowed to deduct that. So that's pretty much all I want to let you guys know, that, when sometimes you feel pressured that we're trying to push you into technology or embracing the cloud, it's really because we have your best interest in mind. And I just want to say thank you to Hector for having me on. And I hope you guys learned something today.
Absolutely. Thank you. Thank you, Mariette. So the last thing I wanted to just discuss briefly is I love this book. It's like 12 bucks in Amazon. It's called 475 Tax Deductions. I believe it's from 2013. And then the same author kind of revamped the book last year, and it's called a Write It Off, Deduct It. And it's a very easy to read book. I mean, if you're a tax practitioner, this is not for you. But if you're a non-tax practitioner, it's a great book. It's a small read. It contains a lot of great reference for new bookkeepers trying to figure out how to categorize expenses. It's crucial for them to kind of read it, and because it explains sort of the logic behind each type of deduction, and it lets the reader know or guide them through, hey, is this a business deduction or isn't it, or what circumstances it would be, and what category would be either on your tax return or maybe in your QuickBooks if you're doing accounting. So I recommend, you don't have to get both books, just get one of them. Write It Off, Deduct It, or 475 tax deductions. I recommend it to almost everyone. All right, so the next episode will be on May 3rd. We're going to have expenses versus fixed assets and depreciation. Our guest is going to be Heather Sitterly, another enrolled agent. And then in June, we're going to talk about international taxation. Still looking for an international tax expert to come in and be a guest. We have a couple of people that I'm interviewing now, but that one should be a lot of fun and very tricky stuff. But next month, join me for expenses versus fixed assets and other recommended events. We have QB Power Hour, which talks about QuickBooks, Enterprise.expert, which talks about QuickBooks Enterprise. We have a brand new webinar called Small Business Power Hour. It's going to start for the very first time on Wednesday, the 19th at 4 p.m. And this is going to be about marketing. It's my first time ever doing a webinar about marketing. So we'll see how that goes. And then there's also Excel Power Hour. So check out all of those: QB Power Hour, Enterprise.expert, SBPowerHour.com, ExcelPowerHour.com, and check out all the other webinars that I am involved with. Mariette, thank you very much for joining us and sharing your time during your extremely busy season. I appreciate it. Go to QB Power Hour, taxpower.com to check out the website. Join the Facebook group and email me your tax questions, and anything I can answer, I will answer. If not, I will refer you to your local advisor. Thank you very much, everybody, and have a wonderful day.